Hello, and welcome to today's webinar hosted by Left Brain Professionals. I'm Steve Bressler, and I'll be your host moderator today. If you need any help at any time, you can email us at support@leftbrainpro.com or use the chat function within the Flow platform. Let's go over a few housekeeping items. Today's webinar is hosted on the Flow platform. You should see a small toolbar with 4 icons in the upper right-hand corner of your browser window. The first button will mute the audio. The second button will put the webinar in full screen mode. The third button enables the chat and the Q&A. And the fourth button enables the settings. Please enter your content questions in the Q&A panel at any time during the presentation, and we'll address as many questions as we can. Use the chat feature to chat with hosts, presenters, and other attendees. Please do not enter your content questions in the chat panel, as they may get lost among other conversations. If you do have connection or audio issues, we have a couple of suggestions for solutions. Turn off your VPN, test your system using the links provided, exit and re-enter the event, try a different browser, connect from your personal PC, phone, or tablet, contact the Flow support, or confirm in the gear setting that your microphone and camera are identified. In order to receive credit for today's presentation, you must respond to 3 of the 4 polling questions. Certificates are generated automatically and will be emailed within 48 hours after completion of the webinar. A survey will display in your browser at the end of today's webinar, and please take a few moments to answer the questions and provide any feedback. The recording of today's presentation will be available on our YouTube channel, and the link will be included in the follow-up email. Thank you for your attention, and without further delay, I will turn it over to Robert for today's content.
Well, good morning or good afternoon. Good morning for those who are like me on the West Coast, and good afternoon to those of you who are on the East Coast. Again, my name is Robert Jones. Today we are here to talk about fixed asset management and depreciation for government contractors. Our learning, got ahead of myself there. Really quickly, who we are. Left Brain Professionals is a boutique accounting firm. We practice primarily accounting system design, implementation, and audit support. And we work only with government contractors, helping them with their government contract accounting compliance. Some of the work that we do is accounting system design and implementation, various DCA audit support, the incurred cost proposal, indirect rates, and we also offer a variety of monthly outsourced accounting packages. You've seen all of our team here, including Steve and Suzanne, who are participating in today's webinar. Our learning objectives at the end of our roughly 1 hour together, you should be able to describe the difference between book and tax depreciation, explain the importance of recording book depreciation, define expensed and capitalized items, explain the process of fixed asset management, and list some of the fixed asset issues that are unique to government contractors. Our first poll question here, give me a moment to launch this, just to learn a little more about who we are working with today. So are you recording book or tax depreciation in your general ledger? And we'll leave that poll open for about 45 seconds.
And I'll read the answers off. It's book, tax, or you're not sure.
And I think we've got everybody participating. So I'm going to let me stop this and share the results so you can see.
It's a quick group.
Yes, and looks like most of you are recording book depreciation, which is good. And for those of you said that you are recording tax or I don't know, we're going to have a little more information for you in today's topic. So let me go back to our slides. All right, book versus tax depreciation. Book depreciation is pretty simple. It's a straight line depreciation. Take the value or the purchase price, the cost of the asset, divide it by the years or months of its life, and there's your monthly or annual depreciation amount to record. Now, it can get a little more tricky if you've got any kind of salvage value in there. And also note here that while straight line is the preferred and recommended approach to book depreciation, there can be some unique situations where another method does make sense even for book. And it's kind of on the rare side. Again, it's usually going to be some type of specialized equipment, and you're probably in some kind of unique industry where you can actually show that the value or usefulness of that asset is not equal over time. Tax depreciation in comparison to book depreciation is accelerated. One of the economic policies of the government is that they want you to buy more stuff, right? And one of the ways that all of our government, whether it's state, local, federal, one of the ways that they implement economic and social policy is through taxes and through tax credits and various programs like that. So no surprise that if the government wants us to buy more stuff and keep the economy going, one way to do that is to provide some type of tax incentive. And so the tax incentive here for assets is that there's accelerated depreciation. The problem with accelerated depreciation when we talk about recording depreciation on the books, though, is that we are skewing the value of that asset over time. It's also note here that accelerated depreciation rules can vary by state. So not only do you have accelerated depreciation at the national level or the federal level, some states may have additional or other tax depreciation rules. Sometimes you have to back out some of the accelerated depreciation from your federal tax return. The accelerated stuff can apply to certain types of assets. There can be dollar limits involved. And those are things that make it difficult to compare companies. And if we step back and remember the whole purpose of U.S. GAAP or any GAAP in general, is that we are developing financial statements that make it easy to compare one company to another. So if one company is following one set of rules and another company is following a different set of rules, now we can see where comparing the financial statements of those companies becomes difficult. So that's why we go back to, from a depreciation perspective, we record straight line depreciation. We don't have any tax issues coming in. We don't have any state issues coming in. And we don't have to deal with accelerated depreciation or any of these things. But also note that there will always be a timing difference between your book and tax depreciation. And that will be as part of the reconciliation on Schedule M1 of your corporate or partner income tax return. Let's talk about recording book depreciation. So again, this is going to be required for accrual-based books and compliance with U.S. GAAP. For our government contractors on the call, remember that in order to have an adequate accounting system in accordance with that SF 1408, which is the pre-award survey for prospective contractor accounting systems, that the first requirement of an adequate accounting system for the government is that you are following GAAP. So in order to follow GAAP, well, two things. In order to be compliant with the SF 1408, you need to follow GAAP and you need to have accrual-based books. So again, two important reasons here why we need to record straight line book depreciation and not tax depreciation. Kind of hinted at this earlier, but if you are recording tax depreciation in the general ledger, you're also violating the matching principle, potentially in a couple of different ways. One, again, by recording tax depreciation, you're skewing the value of the assets over time, and you're potentially misleading users of financial statements, right? So if you take accelerated depreciation and you record that in the books, Now, if I look at the value of the assets on the books, the value of the net book value is going to be lower than what it really is. And one of the other things that we often run into, not necessarily an issue with tax or book depreciation, though kind of comes into play with tax depreciation, is that you should be recording depreciation monthly and not annually. Remember that, again, you're getting the benefit of those assets every month, so you should be recording depreciation on a monthly basis. Again, what we find for a lot of small business companies is that it's easy to calculate tax depreciation. Oftentimes that's the only depreciation that they're getting. So it's not that straight line depreciation is difficult to calculate, but oftentimes they're working with a small CPA firm who may not be focused on GAAP compliance and other things like that. And so they're preparing the tax return, they get the tax depreciation amount and they record that. And when do you prepare taxes? Once a year, so you end up with an annual amount, and now you're only recording an annual depreciation in December. So now, again, if I start to compare month by month, we see some swings in your profitability. Here are some sample lives. And note that I just want to clarify that these are sample. As I say here at the bottom of this slide, that there are lots of asset classes. If you go out and Google asset lives or things like something like that, you're going to see information for railroad cars and cattle and all kinds of stuff, right? You got to remember that if you're running a farm and you're running a dairy farm, as an example, cattle are your assets, right? And how long do you get out of it? How much? What is the life of a cow and giving milk, right? And so, and everything from, again, railroad cars to all kinds of machinery, equipment. I always tell people, make sure you check with your industry, because sometimes as well, if you look at a generic schedule like mine that says manufacturing equipment of 7 years, again, that's a general guideline, but it could be that the nature of the specific equipment that you're using, the nature of the industry that you're in, that maybe manufacturing equipment is 10 years or some other life. Again, general guidance here, computer software, typically 3 years. Computer hardware, you'll often see at 5 years. We typically guide people to depreciate, again, 3 to 5 years. In the world of computers, they tend to become obsolete in about 3 years. So depreciating over 3 years is not an unrealistic thing. Similar concepts for office equipment, right? So if we look at printers, copiers, that type of stuff, again, if you get 5 years out of a printer, you're probably doing pretty good in today's world. Now, things like, office furniture, cubicle walls, that kind of stuff is a little different, right? That is going to last a little longer, so you probably are getting 7 years out of that. Again, just a few other examples here for you. Let's jump into our next polling question. Let me get this launched here. All right.
Our second polling question is going to be, how frequently do you record your depreciation? Monthly, quarterly, annually, or you don't know? And we'll give you 30 to 45 seconds here.
And we've got just about everybody participating. Remember, we do need to participate in 3 of today's 4 polls in order to get credit. So I know we had a few people who joined late. Hopefully you're jumping into this poll, because you do need to participate in 3 of the 4 polls in order to get credit. So we'll go ahead and stop that and share the results. And so we've got really a mix here. We've got about half the people saying they record depreciation monthly, a few of you doing quarterly, and about a fourth of you doing annually. So thank you for participating in that. Let me get back to the slides. All right. Let's talk now about expense versus capitalization. This is often a topic that comes up when we're working with clients, certainly around any kind of fixed assets. They often want to know, should I be expensing this? Should I be capitalizing it? And how do I know what the right answer is? Typically, Items are capitalized and depreciated when they exceed the IRS dollar threshold or other written policy we'll talk about in a moment, and have a useful life of more than 12 months, right? So if you were to buy something, so I remember even years ago, used to work for some companies, and we would buy a $40 desktop calculator, and somebody would want to record it in the books and depreciate it. And I'm like, what in the world are we doing? Right? It's a $40 calculator, folks. We don't need to be depreciating that. Similar things for cell phones. Now, in today's world, cell phones are a bit more expensive, but even still, if you're spending $500 or $600 on a cell phone, right? I mean, what's going to happen? How many of you, if the cell phone breaks, what do? You just go buy a new one. It might be an expensive day for you. You're a little upset, but we're pretty much usually just going to go buy a new cell phone and move on with life. Now, if you're buying something bigger, then that's a little bit different. The IRS does give us some guidelines on this expense versus capitalization. There is a de minimis safe harbor of $2,500, which went into effect for tax years after January 1st, 2016. It was previously only $500, and they did raise that limit. You can have a higher limit of $5,000 for entities with an applicable financial statement. You can have higher limits than that as well. And we often see, again, for much larger organizations, having an expense versus capitalization of $10,000 or more is not unreasonable. Again, it's got to be tied to the size of the organization, the type of assets that you buy, et cetera. Prepaid expenses is one that I always like to help people align with their capitalization policy, and generally say that your prepaid expenses should follow the same rules and limits, but note that we are amortizing those, not depreciating them. Looks and sounds kind of similar, but there are some differences to that. We are amortizing those prepaid expenses over time with the same thresholds. So let's talk through a couple of examples here. Let's say you spend $1,500 on a piece of software with a 2-year life. I say that that's expensed. You might say, Robert, but it's got a 2-year life. But it's $1,500. It's less than the IRS de minimum, so it should be less than your internal policy for expensing items. I spend $3,000 on an item with an 18-month expected life of software. We're going to capitalize that. We're going to capitalize it for a couple of reasons. One, the $3,000 is over my $2,500 limit, and the 18 months is longer than 12 months. So I'm expecting to get more than 1 year out of it, and it's more than my threshold. What about a software? And all of this gets interesting, right? In today's world, there is still some software that we purchase, and we have a perpetual license, meaning that I bought the software and it's mine, and I can continue to use it for as long as I want. And if you back up, 3 to 5 years, that was still fairly true. You could go down to Staples or somewhere. You could buy a copy of QuickBooks. You could buy a copy of Microsoft Office. You got it on a CD. You came home, or to your office, you installed it on your computer. And if something went awry, you got out your CD, you reloaded it, right? And you owned that software. You owned that license for as long as you could keep the CD and keep it running. That was yours to use. In today's world, and that same concept obviously applied for very expensive software. So when we would install accounting software, Microsoft Dynamics Nav as an example, you might spend $50,000 for a larger organization on software, but you owned it. You could use that software for as long as any computer or anything would support it. Now we live in a world where everything is subscription based, right? We pay for access to the software. Most of it is hosted online, and we simply pay for access to the software. And if we stop paying, then guess what? Then we no longer have access to the software. So if I go down to my next item there with a little bit of that understanding, what if I've got a software annual license of $3,000? I'm saying that that's expensed and amortized monthly. We're going to follow our matching principle on that, right? I'm paying $3,000. I'm over my threshold. I've basically got, and it's usually a prepaid. I mean, typically on these things like this, you're paying $3,000 or whatever the amount is upfront for a full year of access to the software. In that particular case, I'm going to put it on the balance sheet as a prepaid expense. I'm going to amortize it over the 12 months. Let's look at an example like liability insurance. Again, whether it's professional liability, general liability, fire insurance, all that kind of stuff, we're oftentimes paying a full annual premium up front. And many of us do that either oftentimes because we get a discount. We don't have to pay monthly fees on top of it. So if your liability insurance, for example, was $7,500 this year, it's going to be expense, but I'm going to amortize it monthly, right? So I'm not capitalizing it. I can put it in a prepaid expense account on the balance sheet. I'm going to amortize that out because it's only for a 12-month period. One of the other reasons that we want to be careful about some of these prepaid expenses and how we amortize and why we put them on the balance sheet is that the other reason is typically these things do not run in a clean fashion from January 1st to December 31st. Right, your liability insurance might renew August 14th. Okay, so if you put all of the $7,500 in 2022, is that really fair to 2022? Is that fair to August of 2022, as an example, to put all of that expense in 1 month or 1 year? No, it's not, because I'm getting part of the benefit of that insurance this year, and I'm getting part of the benefit of that insurance next year. So I would say at the very least, you certainly need to split it up and again, at least get the amounts related to the fiscal years in the appropriate fiscal years. But I also, again, tend to be a stickler and say that large dollar amount, we need to be consistent in how we do all of these related types of transactions and amortize that monthly. Remember, we are getting a monthly benefit from it, and it ties back to some of our matching principles for GAAP. Let's take another example here and talk about a delivery van. And I've got two flavors of this. One of them is a much deeper dive, but I do want to introduce you to the idea. So let's say I purchase a delivery van and it's $40,000. I'm going to capitalize it. I think everybody knows that. Pretty simple, straightforward, right? I'm going to have an asset on the books that says delivery van, $40,000. I'm going to have a liability that says, bank note payable, $40,000. And when I make my payments each month, I'm going to record a portion of that payment is going to the premium, and a portion of that payment is going to go to interest expense. What if I decide to lease the van instead of purchasing it? Well, in the past, these were typically treated, not always correctly, these were typically treated as like an operating type of lease. We said, hey, we've got a monthly bill from the leasing company, just like we pay rent every month. We don't, and now all of this has changed. But in the past, we typically did not report having a building lease. We did not report having auto leases or printer leases and that kind of stuff. We're not part of the balance sheet. And that was referred to off balance sheet financing, if you're familiar with that term. Right, so it's off balance sheet financing. Many companies got in trouble because they went out and leased a bunch of stuff. They had long-term commitments. These long-term commitments were not presented clearly sometimes not at all, and sometimes not very clearly on the balance sheet. So now somebody comes along and they're making a decision based upon that balance sheet, and what kind of decision might they make? They might end up loaning money or investing or doing something thinking that the business is in a different financial position than it really is, because we're not clearly and accurately presenting all of these lease liabilities. So we now have guidance under ASC 842, went into effect previously for publicly traded companies, went into effect January 1st of 2022, so this current year. For private companies, so for fiscal years that started after January 1st, 2022, we have to present and record leases in accordance with ASC 842. It's very similar. It feels like capitalization and depreciation. Essentially, what we're going to do is calculate the present value of the total payments of the lease. We record a right of use asset. So now I've got to have a delivery van or a printer or a copier, the building that I'm in, right? So if I've got a signed lease, obviously, for the building that I'm in, all of those types of things. There's a much deeper dive in this, so don't take the couple of minutes here that we're talking about this and think this is everything, but I want to make sure that you guys are aware of this. We do have to record a different class of asset. Again, it is referred to as a right of use asset. So we would also want to be careful because you might be in a situation where you've purchased some vehicles, but you're leasing some vehicles, right? You might actually, depending on your business, you might buy delivery trucks and delivery vans because that might make sense. You think you're going to get a longer life out of those. And maybe it makes sense to purchase those, but maybe you lease automobiles for salespeople or other people, right? So now I can't just lump them all into a vehicles class on my balance sheet. I have to have my purchased vehicles, but I also have to have the right of use assets for those leased vehicles or leased items. Much deeper dive. If you have questions about that, certainly send us an email. Happy to schedule some time and chat with you about it. We've got another polling question here. Let me get this launched for us. Here we go.
Okay, what is your capitalization limit? And I hope that my audio is coming through clearly. Options are 2,500, 5,000, 10,000, something else, or I don't know. We'll give you about 30 or 40 seconds. Make sure everyone has a chance to respond.
So it looks like most people have participated. We're going to give you a few more seconds. Remember, you do need to participate in the polls in order to get credit for today's webinar. So we'll go ahead and close this out and share the results with everybody. So we've got responses across the board. Small portion kind of following that $2,500 guidance from the IRS. We got at least a couple in that 10,000. For those of you that said something else, I'm curious if you'll just throw something, you can put it in the attendee chat. Tell us what that is. I'm curious if your something else is less than $2,500 or if it's more than 10,000. So if you answered something else, just put a little note in the chat. We'd like to learn more about that. All right, let's go back to our slides. All right, now we're going to talk about fixed asset management. And in particular, we're going to talk about asset tracking. And what I tell people, this is more than just depreciation. So this, I think, is another area where people get caught up in what should be depreciated, what should be expensed, what should I be tracking, how do I track it? Let me go back to my cell phone example. So let's say I buy a new iPhone. I'm going to say it's an even $1,000. It's going to be give or take of that, right? So it's $1,000. It's less than my threshold. So I'm going to expense it out. I'm just going to pay for it today, be done with it. I'm going to expense it in the month and move forward. However, that iPhone is still a pretty valuable item. I mean, it is $1,000. It's also valuable because it is a piece of technology. People can access their email. We want to know who has the phone, where it is. If an employee leaves, we want to make sure we get the phone back. We want to, and when we get the phone back, we might need to, we probably want to give that to another employee if somebody replaces them, right? So tracking that phone, knowing who has it is very important. Obviously, same concept for laptops and other types of things. They might be below that threshold, so we may not be depreciating them. And sometimes, unfortunately, what we find is that we go into clients and we start asking questions about this, and they say, well, or really what the issue is that somebody leaves, and then we discover, oh, we didn't get a laptop back, or we didn't get the phone back, or we didn't get something else back. And somebody says, well, we expensed it, so I didn't put it on a list anywhere, right? Nobody was tracking it. Nobody did anything. We have to remember that fixed assets really are all of those fixed assets. They can be the cell phones, they can be the laptops, they can be those things that are less than our threshold, but they're important enough for us to track. We might need to install software on them. Again, we want to make sure we get stuff back from employees. It might be a camera, and we want to know who we've loaned the camera to, which department has the camera this month, as an example. So we need a way to track all of those assets, okay, regardless of whether we are depreciating them. Now, I don't have any particular software. There's a lot of software that's out there. If you're using QuickBooks Desktop, there is a fixed asset manager in there. Most of your other, I'll say more advanced accounting software typically has some type of fixed asset tracking in it. There are depreciation software from companies like Sage and others that specifically do depreciation. Most of them obviously are going to have some pretty straightforward defined fields. Usually you have some custom fields that you can put in there. Here are the main things that you want. There may be others for your organization. Obviously having an asset number, a description, get the model number and the serial number, right? So that we know, don't just put down, again, we see this all the time, HP laptop. That's what's listed, HP laptop. Which HP laptop? Because then when you start going through the fixed asset listing, you see that over time they bought 13 HP laptops over a 2 or 3 year period. And now it's like, okay, we're trying to reconcile the fixed asset list. I counted 10 HP laptops. It says we bought 13. Which 3 do we not have? I don't know which 3 we don't have because nobody put in information for me to be able to track that, right? So having a model number and a serial number, very helpful. Obviously, we want the date in service. That's going to help us if we are depreciating it. So if it is something that we are depreciating, we definitely need the date in service. The date purchased, and why do I have the date purchased separately? Because oftentimes we purchase something and it may not actually go into service until later. We may not be able to put it in service until later. We might need to, especially on a lot of larger equipment, we may be buying pieces of stuff and assembling it into a larger usable item, and that the larger usable item may not be able to go into service until some other point. Having the vendor, who did we buy it from? What's the warranty info? When does the warranty expire? The next 2 that I have left and right there are photo and receipt. One of the things that we do internally for us is take a picture of it. Why do you take a picture of it? So there are a couple of reasons. One is I know what it looks like. Now you might say, well, Robert, I know what an iPhone looks like. I know what an HP laptop looks like. True. But sometimes there are other types of assets that aren't as easy to identify, or there are assets that are very similar. What if you bought 4 digital cameras over time? Having a photo of it can help you better identify it. Having photos and this kind of information is also very helpful for insurance claims. So what happens if there's a fire, if there's theft, or if there's some type of disaster, somebody loses it, and you need to make a police report or you need to make an insurance claim? This kind of information goes a long way in substantiating that claim and making it easier to process that claim. Same thing for the receipt, right? Having a copy of the receipt with your records is very helpful, because what if you need to go back and substantiate the price of it? What if you need to file a warranty and you're having issues filing that warranty, but you've got a copy of the receipt that shows how much you paid for it, when you bought it, who you bought it from? Other items here on the left at the bottom. Again, if you're using something, if you're using a depreciation software, the software is going to let you define which GL account for the fixed asset, the accumulated depreciation, and the depreciation expense are associated with that asset. Really helpful when you're in a larger organization. And especially that last one on the bottom left there, the depreciation expense account, you might have multiple depreciation expenses. You might have depreciation expense in facilities. You might have it in overhead. You might have it in G&A. You may have multiple ones in overhead based upon departments or functional areas or something like that. So having this kind of setup in your depreciation tracking software is helpful, because then when you calculate depreciation and run reports, it automatically tells you what the depreciation expense is by department for your journal entry. It makes it a whole lot easier. Associated with that on the right is what I put in here is the location or and the person or the responsible party, whatever you call it. Again, if you bought 13 HP laptops, where did it go? Who did you assign it to? Which division is it in? Which department is responsible for it? Which department should be getting the depreciation expense? So having that location there can also help you validate that you've selected the correct GL depreciation expense account. Reconciliation. This includes regular review of the list of fixed assets. Particularly troubling here are sales, trade-ins, and abandonments. And Suzanne, I know you've worked on a number of fixed asset reconciliations like me. What are some of the other issues that you've encountered along the way, or what are things that you see people doing?
I mean, you already discussed one of the biggest problems. One of the biggest problems is just simply having a good solid list of what you actually have, because so often during audits, you have to go back out and track those assets down, especially if they're spread across the large area. So if your list isn't really well done and really updated, it just causes problems all the way across.
Yeah, and that's obvious. It can be difficult during a financial audit. If you're going through a regular financial review or audit, it can be difficult in a even in a DCA audit, right? If you're trying to substantiate the depreciation cost of something, they may want to get in and say, okay, show us the list to fix that, show us the assets, prove to us you have the assets, right? So any of that kind of stuff.
And in a shipyard setting or any kind of manufacturing setting, you do have to go out and walk and find those assets. And sometimes they're not left in the condition that you expect them, or they're not there at all.
Right. And I was going to say, and I know you and I have walked in, right? We've walked in after other people. Business has been operating for a while, and people don't do this. And that's where I go back to sales, trade-ins, and abandonments. Is oftentimes we buy a piece of equipment, we go to do an upgrade, and we can get something for trade-in. Even if it's a few $100s for them to just get it out of here and move it away, they might give us a few $100s in scrap metal for it. We still have to, and somebody says, great, the guy in operations is going, oh, wonderful, I don't have to deal with it, they took it away. But if we don't record that on the books and get it off the books, then we don't really know what our assets are. And so even though it might even be fully depreciated, it's still there and it's still lingering, and it's causing a misleading representation of what the assets are.
It's also really important to have it be part of a regular process that you've established, so that it doesn't all just pile up for the end of the year. At the end of the year, it's going to be really hard to figure out what happened in January or February and go back and make those corrections. And it ends up being a lot at year end with everything else that's going on. So finding ways to compile it and do it, intermittently is helpful.
No, that's a good point, especially for those organizations that have a lot of activity. So some of you out there might be saying, we add a couple of things a year, we reconcile it once a year. And that's probably okay, and I would say even for our organization, we don't have that much activity in terms of buying laptops and doing other stuff. So an annual reconciliation is pretty simple and straightforward. But as Suzanne said, you're in a shipyard, you're in a manufacturing facility, you're in either a larger organization or a dispersed organization. You're in an organization that's buying a lot of fixed assets. Again, I used to work for a manufacturing company. We were all the time buying something. I mean, every month there was always something going on. So yes, you need a reconciliation schedule that aligns with the size and complexity of your organization.
And getting them off is just as important as getting them on.
Yes. Yes. All right. Continuing on with our fixed asset management conversation is repairs and maintenance. So this is always an interesting topic that I think a lot of people overlook. When we're talking about repairs and maintenance, the question that we need to answer is, does it extend the life of the asset? If the answer is no, then it's just a period expense. Okay. Pretty simple, straightforward. If the answer is yes, that repairs and maintenance does actually extend the life of the asset, then we need to adjust the basis and the remaining life. So let me give you a couple of examples. New tires on a car, period expense, right? It's wear and tear. Yeah, you're going to get 5 years out of the car. You're going to depreciate it for 5 years, but depending on how much you're driving, 2.5, maybe 3 years in, you're going to need a new set of tires. And somebody might say, well, but Robert, I'm going to get more life out of the car if I keep putting good tires on it. Well, are you really? Probably the reality is you're more likely to get the full 5 years right out of the car by keeping good tires on it, but you're not necessarily going to get more than 5 years out of it just because you put new tires on it. So is it something that is normal wear and tear and regular preventive maintenance? Probably doesn't extend the life of the asset, and it's a period expense. However, what if you need to replace or rebuild the engine? That's something that would likely extend the life of the car, right? And it goes into my example on the next slide here. I got a car, a cheap car in today's world at $20,000 in my example, but I got a car. I'm going to depreciate it for 5 years. That's $4,000 a year. But I need to rebuild the engine that cost me $7,000 at the beginning of year 4. So let's clarify, at the beginning of year 4. So 3 years of the asset have been depreciated. And by rebuilding the engine, I'm extending the life I'm going to get 5 more years out of that car now. And let me just clarify here, if I didn't rebuild the engine, the car is pretty much dead, right? Right now, it's not running. I blew a gasket, something happened. It's going to be either dead at the end of 3 years, and so I'm going to have an asset that I haven't fully depreciated, or I'm going to have to rebuild the engine, but rebuilding the engine actually gets me 5 years out of the car. So I'm going to get a total of 8 years out of this car, the 3 years that are already passed, and I'm going to get 5 years into the future from today because of rebuilding the engine. So what do? My remaining value is $8,000. Remember, I already depreciated 3 years, so 3 times 4 is 12. 20 minus 12 is 8. That's my $8,000. I've got $8,000 book value remaining. I just spent $7,000 rebuilding the engine. We agreed that that is extending the life, and so I need to adjust the basis. My basis is now $15,000, and I'm getting another 5 years out of it. So I've got to reset and say, now I'm going to depreciate that $15,000 over the next 5 years. So I'm going to be depreciating $3,000 a year. These are one-off types of things. They're manual calculations often that we have to go in and figure out. But they are important because, again, maybe don't see this quite as much with things like cars, but definitely with some manufacturing equipment, it's not uncommon to have a situation where, okay, we're going to invest tens, maybe even hundreds of thousands of dollars into repairing or rebuilding an asset that maybe it's even been fully depreciated. Maybe it hasn't, but we have to evaluate those types of things and make sure that we're recording them correctly. Let's talk about some unique GovCon issues. This is always kind of a fun topic that comes up. And one of the question I always ask the client when they come to us is the item a deliverable of the contract? And we always get into semantics and people always like to argue. For me, it's usually pretty clear. If it's a deliverable of the contract, then it's a line item on the contract. You've got a CLIN that says you contractor will deliver equipment ABC 1, 2, 3. We're buying equipment ABC 1, 2, 3 from you. Very clear, very straightforward. That is a deliverable of the contract. And invariably, somebody will come along and say, well, we don't really have to deliver it on the contract, but I wouldn't be able to do the work if I didn't buy this piece of equipment. So now I'm spending $100,000 on this piece of equipment in order to execute the contract. And And so it's a cost of that contract, and I got to bill it to the government. Again, the question is, are you delivering that item? Now, sometimes you are. I have certainly seen situations where we bought test equipment specifically for a contract, and we delivered that test equipment at the end of the contract. So we used the test equipment for the execution of the contract, and it was understood and agreed upfront that when the contract was complete, we would deliver that test equipment to the government, because they would take that and put it in their own labs and facilities to use once we were done with it. Again, in that case, then it's a deliverable of the contract. But if you're buying test equipment to test something that you're manufacturing, as an example, that's an overhead cost. You need to follow your regular depreciation policies and procedures. Again, whatever those dollar thresholds are, whatever the class life is, et cetera. Got a couple of examples here to try to drive this home. What if I'm buying materials or assets for or on behalf of the government? Meaning, again, I'm delivering those items as part of the contract. Some of you out there might purchase material for the government, right? Often, and we see this with a lot of our clients, the government buys things through contractors, and they do that for different reasons. But sometimes the contractor, their role is to procure these items, sometimes assemble them, sometimes just procure them and get them delivered. But we're buying material or assets for or on behalf of the government, and oftentimes those assets exceed that dollar value, right? We might look at it and say, hey, I just spent $10,000 on something for the government. Probably sounds like I need to depreciate it or do something with it. If you're delivering it as a deliverable to the contract, then it's a direct cost and it's not depreciated. And that's also the thing I want to clarify. It's a direct cost at that point, right? It's a deliverable of the contract. But if I'm buying machinery or equipment, back to my example of the test equipment, if I'm buying that to carry out what I'm supposed to be doing on the contract because I need to test something, then that's an overhead cost. And again, I'm going to follow my depreciation policies and procedures. And again, it's just as important here to note for our government contractors on the call, just as important to note the difference between the depreciation and expense as it is to note the difference between a direct cost and an overhead cost. Okay. And also want to clarify that you would not depreciate it and charge depreciation as a direct cost. So if there was a situation that you were buying something for a contract and you agreed, well, we are going to depreciate it, but I only bought it for that contract, so I'm going to charge it as an overhead only on that contract, or something. It doesn't really work like that. If we're depreciation and it goes into overhead, and it's spread across all contracts. All right, I gotta get a couple more minutes in here, so I want to jump to some Q&A. I think we've got some questions out there, and we'll come back to that. There we go. Get the Q&A open here. And let me bring back Suzanne for the Q&A. So Steve, do you have some questions for us?
Yeah, we've got a couple questions. One of the very first ones was from Vin. He asked, we are thinking about raising our limit of capitalization from 2,500 to 5,000, but our fractional CFO, who is not familiar with FAR, is suggesting 10,000. Is there a max limit that is okay with FAR?
So the main thing is, one, having a written policy and procedure. That's always going to be key for anything. And obviously being consistent and following that. And I would say, again, the dollar amount needs to be commensurate with the size and complexity of your organization. If you are, and there's no hard and fast rules here, if you're a $1 million company, $1 million in revenue, then $2,500 to $5,000 is probably the right amount in order to set as a threshold. Having a $10,000 threshold for a $1 million company is probably stretching it a bit, and you're probably going to get somebody say, is that a reasonable number, right? So we're getting around that reasonable aspect of this. If you're a $50 million company, having a $10,000 limit for capitalization probably makes sense, right? That's probably a reasonable number that if you expensed it versus capitalizing it, is it going to have a significant impact on the presentation of the financial statements? From a FAR or government perspective, is expensing $10,000 versus capitalizing it going to have a significant impact on the indirect rates of that organization? Again, if you're a $50 million company, you know, it's probably an immaterial number, and $10,000 is the correct answer. Any other questions?
And we have one more question. What non-federal guidance is used for the capitalization of assets?
So I'm not sure exactly what we're asking about here. The way I will answer this is if you go looking, I would tell you that it's difficult to find. Again, particularly if you look at something like trying to find a defined list of asset lives, there's no US GAAP FASB list of asset lives, as an example. You're not going to find that, unfortunately. Again, the best guidance that you're going to get for some of that stuff is going to be from the IRS for class lives. Again, there's a lot of industry standard stuff out there, so that's why I tell people, if you're buying something other than, you know, the traditional office equipment, computers, furniture, cars kind of stuff, if you're buying manufacturing test equipment, something unique to your industry, I would do some research specifically on that type of equipment or on your industry to get better guidance. All right, let's go back to our survey here so we can get our fourth poll question in so people can answer that.
Yeah, so the fourth poll is, what help do you need with your fixed assets and depreciation? And we've got government contractor, unique issues, prepaid expenses, leases, something else, or none, and you've got it totally under control.
We do have a couple of more items to cover here. We'll let people finish answering the poll. Again, just a reminder, you got to participate in 3 of the 4 polls in order to get credit for today's webinar. Those emails will go out in the next couple of days from an automated system. We do have additional topics coming up. Just as a reminder, we do webinars the second Tuesday of every month at 1 p.m. Eastern Time, 10 a.m. Pacific. Next month's topic coming up is going to be revenue recognition for government contractors. And some of you are probably aware of this, but there are some unique issues, again, for government contractors around revenue recognition. For December, we have evaluating accounting software for government contractors, and then starting out the new year. And let me get another slide up here for everybody. Starting out the new year, we're going to do a 3-part series on the best formula for surviving the incurred cost proposal. Do want to say thank you for joining us today. You can follow us on social media. If you've got any questions at any point, follow up, send us an email, support@leftbrainpro.com. You can go to our website where you can get a link to our YouTube channel. We put all of the recordings out there. We're above 40 videos out there right now, so subscribe and follow us. You can watch any of the videos for free. Unfortunately, the CPE credit is only available for live presentations, but there's a lot of really good info out there. And then again, on our website, you can see the upcoming webinars and register for those. Thanks again for participating today, and we look forward to seeing you again next month. Take care and have a great day.